already have some bloopers, so this is cool. And, but yeah, dude, just to kind of start us out with, man, obviously it's January the 15th, 2022, first time ever recording, and good time. It's the beginning of the year. It's a kind of a funny time. But before we get too crazy into it, man, I guess I could start us off with a prayer, and just get us doing right, get the year going right,
Absolutely.
But yeah, all right, you guys. Dear Heavenly Father, we just thank you for another Saturday that we get to spend together as friends. And we just want to ask you to bless this conversation, bless our friendship, just look after our country, help us all, not just us, but if we ever have any listeners or anything like that, but just help us to be good stewards of our money and to be right about that too. And there's so many catalysts that affect our markets and our economy and just the world that we live in here in the US and just all those other nations as well. And we just hope that we can be wise and see these opportunities and just advance your kingdom in any way that we can, and just using our gifts for that. And it's in your holy name, Lord, that we pray. Amen.
Amen.
Yeah, thanks, guys.
Amen.
But just to kind of start out with, I think the biggest hit or the biggest thing that I noticed that actually happened yesterday, which I'm sure that you guys saw too, was JPMorgan. And of course, that's always a big deal. I feel like that's always the start of like earnings season, right? Like it's always like JPMorgan is like one of the first ones that always release their earnings, but obviously they missed expectations. Yeah. And I must have been like a couple of months ago where Misael and I were talking about it, and I think he made me do like a lot of research and think a lot. And today I'm like so in love with JPMorgan. Like I'll tell everybody to get it. And I know it's pretty big. I know that it's not like a small growth stock, it's not like a $6 Tesla, right? But I still think that we can learn a lot from them.
Yeah.
Oh, what's up?
No, go ahead.
Oh, yeah, sorry. In the sense that I was like listening to the JPMorgan CEO speak yesterday, and I think that he was very optimistic, not just about his stock, but like about just the U.S. economy too. And like, I mean, I know it's like a global practice too, and I think that that what missing expectations like meant actually.
Mm-hmm.
And so I could speak a little bit more about that, but I want to know what you were going to say.
Yeah, no, I think you're referring to they missed Q1. Was it Q1? Because they had a record quarter in Q4, or not a record, but like a really strong Q4 quarter, and then Q1 kind of missed expectations. But we have been talking about that a little bit because obviously banks survive off of interest rates, and they haven't been doing too hot. For a little bit at the beginning of, it's probably towards the end of last year, we thought that they were going to start going back up, and then they didn't. Well, I guess they did, but then they kind of plateaued. So I think it finally caught up. Yeah.
No, yeah, that's. Oh, what's up?
I was just saying, I think this earnings season might be a little bit difficult for the financial sector because expectations have been just really, really high for that sector. But fundamentally, there's obviously like the tailwind of increasing interest rates. So we would expect, of course, like as like the 10-year yield continues to rise, then so should, in theory, the financial us. But those are like two competing effects. So it's a little difficult to say what's going to happen in the next couple of months. People are going to focus more on the fundamentals, or if those fundamentals are already priced in sufficiently. Some of the I guess the financial plays that I was looking at, like say FAS, have proven more defensive than I was expecting versus actually taking more ground, with a lot of people being skittish over some of the immediate rate increases, but then also with some of the disappointments like with like JPMorgan. So that also is a part of FAS, the leveraged ETF in the financial sector.
Yeah, dude, I really like that FAS too, man. I was actually looking at it a little bit before. I know that's one that we've been talking about for like a little bit, and I still can't believe that I'm not actually in that one. but I was looking at the chart of it and I was just like, man, this is like, I clearly like, I should have got into it when Josh got into it because it's like it's still going up despite like all this craziness. But and I'm like, obviously like interest rates has been like a super hot topic, man. I remember speaking with my brother like months ago and I was just like, dude, they should have raised the rates like way before now. Like I understand like why they didn't, you know, and I'm like, I don't know. I don't understand like the other parts of like the US. You know what I mean? Like I think there is like a culture difference with like how like shutdowns work. You know, I was actually speaking to one of my colleagues yesterday who's in Pittsburgh, Pennsylvania, right? And he was saying that you actually have to show like your vaccination card to like go to like concerts and like all those kind of venues, you know? And
Yeah,
so
each
I
state
mean,
has their own kind of like restrictions. As you cross state lines, you have to like the number of people that can gather for holidays or events and stuff like that. That changes. So I'm not surprised by that.
no, yeah. And so I mean, you know, with that kind of being said, I see why Jerome Powell was like kind of like hesitant to like just raise the interest rates, like I guess before now. But like again, I think we should have just like had like taken that hit when we needed to. But yeah, dude, he seems pretty optimistic, JPMorgan. And like, you know, missing the expectations,
Yeah.
like the revenue part of it they missed, you know. But that he was speaking on that and he was just saying like the biggest part of that was like the loans like decreased, the amount of people
Decrease.
getting loans. And so and he kind of put it in this interesting perspective and like I was trying to rationalize what he was saying, just like from like what we know and what we've experienced. But he was just saying like, you know, people get loans when they're like under leveraged, right? Like when they need money, you
Hmm.
know. But it's like, but the consumer, you know, the people, the businesses, and like let's be sparing about that. Like JP Morgan doesn't really service guys like me, like little guys. You know what I mean? Like they probably have some pretty high net worth like consumers, you know, that they have, but he was just saying like people have the money. And I was like, you know, that makes sense. We've been through like this great resignation. People are going to like new jobs and like getting paid quite a bit, right? And so I was like, okay, that kind of makes sense, but it just kind of makes me feel a little bit better too that
Right, right.
maybe like we're not really like over leveraged. You know what I mean? Like I
Well,
don't.
one thing that I want to mention is that it's interesting. The obviously you guys know that I'm like on a financial discipline kind of like diet,
Mhm.
and that book, by the way, is like Master Your Money by Ron Blue. I recommend it. But anyway, um, the chapter on debt, right? He talks about some of the myths and the truths about debt or credit and all that stuff. One of the things that was like a myth was that whenever there's inflation, you should get credit because essentially you end up paying less to the bank. You know,
Mm,
for example, if your inflation's at whatever, just 3% when you get your loan, 30 years out, say the inflation is like 16%, obviously the money is worth less. So then you're paying less for it. And so looking at the CNBC article that talks about that, saying that they're citing inflation as one of the headwinds that's going to affect their guidance for the future. And so that makes sense. You know, that's what's happening. That theoretically, yes, you know, it's a good idea to,
mm,
it may be a good idea. It may look, attractive to get a loan right now as inflation rises, but inflation is not always going to be up at the
mhm.
same rate, right?
Yeah.
Ultimately, the rate at which you earn your money, your returns in the market is always going to outperform whatever the inflation does, because obviously the Fed, the government, they're going to try to control that inflation. But like short term, if the inflation at the way that inflation is moving at the moment, it makes sense that the bank is going to lose money because that works against their business model. So
Mhm.
it's kind of like an interesting point there.
Yeah. Which is why it's like super like tempting and probably a really good idea to get into FAS, you know. Just I mean, especially right now. I- But
yeah, I would say like FAS is probably going to be seeing or like the underlying constituents are going to see I think a bit more interest in those companies, mainly because like with the Fed's like pulling back on like their easy money policy, that should cause the interest rates to rise and then fundamentally benefit the bank's business model like over the next couple of years, as maybe we see the 10-year yield maybe hit 2% later on this year. It's just like I would say like FAS hasn't performed as well as I was expecting. Maybe it's because of the expectations already being set so high for those constituents. I have only seen so far, at least in my portfolio, around like a 20% boost for FAS, and that's obviously that's really nice compared to with an investment that's under a year old. But if it's a leveraged portfolio, I'm kind of expecting more like out of it. But I did have like a friend who was investing quite a bit in TQQQ. I recommended, and due to like the rate hikes being imminent, switching over to FAS, and that saved that individual like quite a bit of money, since TQQQ has taken quite a few hits over like the past month, just due to some market turbulence over the bond market. But still, I would say so far FAS has turned out to be more defensive than I would have liked. It's in the sense that it hasn't really gone down so much. It's gone up a bit, but it just mainly has outperformed by just not going down in terms of value. So yeah, I think FAS is a good investment, but it's not necessarily, or it hasn't performed as well as I had hoped. And
so Josh T, can you explain just what FAS exactly is, or kind of does, like the vision for FAS as an asset in this climate?
So FAS is an ETF that contains a lot of different like stocks in the financial sector, so such as JPMorgan, Bank of America, and etc. It's different from unleveraged ETFs in that it doesn't have like its constituents aren't actually the direct stocks, so they don't necessarily have your main focus isn't actually on just buying the underlying stocks. They're buying derivatives of these stocks, so they might be buying, let's say, options or futures in these individual stocks, and those derivatives are going to basically leverage are kind of like leverage positions in which you can expect to see more movement compared to the actual underlying constituents. So in practice, that means that maybe Bank of America moves up by 3%, or all of their constituents move up by 3%, because they have enough derivatives such that it will actually cause FAS to move up 3 times what their actual constituents are moving up by. So if all their constituents are moving up by 1%, FAS is going to move up by 3%, and that allows you to essentially take a leverage position in a combination of options, futures, and other derivatives without actually directly owning those derivatives yourself, because it can be pretty expensive to own futures for the average individual. So that kind of allows you to wrap all of those derivatives up into like a really nice leveraged ETF without having to manage it yourself, because actually doing that yourself would be pretty difficult, or it would also require a lot of management and also capital to actually get that 3%. So FAS is a great way to get exposure to a lot of different like the financial sector stocks while getting more movement out of that sector than you would by directly owning those stocks. Because like even today, you can actually just purchase fractional shares and almost like emulate what you would get with some ETFs, but actually getting into an ETF that has like leverage positions like futures is far easier than actually buying those leveraged positions yourself, which would require tens of thousands of dollars for each of those individual, say, futures contracts.
Yeah, I mean, I think it goes to say too, you mentioned that it goes up. Like if Bank of America goes up 1%, FAS will go up 3%, right? But I think it also goes to say that, if it goes down 1%, it also goes down 3% too, So,
yes, that is true.
But I mean, but with that being said, and you mentioned that it's up 20%, like I would say that that's like pretty good, especially with what's been going on like since like January 3, the first trading day of this month, it's been just wreck of a havoc in the market. But I mean, that's obviously that's really more on like Jerome Powell and the Fed, because they don't want to give us like an answer. They've just been like,
Yeah.
they've been like here, like, you know what I mean? They've been dodging everything and just trying to like, so
Right.
that's why I feel like, man, it's gonna be pretty rocky until they like finally just tell us like this is what it is, right? And then
Yeah. So
so I
going
mean,
back to, it's interesting though, because the Fed has like their work cut out for them. Going back to the article, the CNBC article for JPMorgan, part of the reason why they also suggested that they were going to have trouble was like the labor market. And this
mhm,
specifically, this quote is saying here, when asked if a tight labor market was forcing JP Morgan to pay its personnel more, Barnum had this response. It is true that labor markets are tight. But there's a little bit of labor inflation, and it's important for us to attract and retain the best talent and be competitive accordingly to performance. So basically, there's also, there's several ways through which inflation can be driven. Inflation can be driven through a higher demand for something, which obviously, if there's a higher demand, then to compensate, you have to increase the price a little bit to kind of dissuade or like take the pressure away from the product. But the other way that inflation can be forced up is by less people again being available to do the work. So then your costs rise, and then that is transferred over to the total price to the customer. And in
mhm.
this case, I think the great resignation that's going on right now is not helping, right? The inflation story. There's a lot of people out there that are not working. Obviously, there's two groups of people that are quitting their jobs at the moment. It's first of all the baby boomers who are pretty much retiring, and the second generation. The second aspect is like the Gen Z, so people who are like either they're working those jobs, like the I think Gen Z it's teenagers at the moment. Is that right? Um, but anyway, that kind
Mhm.
of explains it a little bit, the inflation aspect.
Yeah, I was actually reading an article that owned like by Edward Jones that actually hit a few like the same notes that you mentioned. One was just that the CPI like rose by 7% in December from a year ago. So that's the fastest pace since 1982, and also like the 8th straight month in which it exceeded 5%. So that's pretty significant. And then they even like broke it down in the article in that the goods were actually a large part of that inflation. So furniture like soared like to like 14% more than a year before, and used cars and vehicles in general also rose by more than 35%. But I think even like broke it down even more in saying that the prices of goods are kind of cooling off, but inflation in the future is going to be more driven by services versus goods. So people quitting their jobs is going to continue to drive or act as like a catalyst for higher inflation versus goods being the major catalyst. So I think we just
Makes
have
a lot of sense.
conditions where people don't really want to work. Like, I mean, if you work in the service industry and people are mistreating you and you're not getting paid what you need to survive, you don't have much incentive to stay in that position. So you might want to go to like either somewhere else, or if you can afford to, just take a break, as like some people have, in the hopes that wages will increase in the future. So and if wages do increase, that also will increase the cost of like those services. So as I think like as we see some people getting paid more and more fairly for the value that they're generating, given like the more difficult social conditions like that are post-pandemic, then I think we're just going to continue to see some service-related prices continue to go up. But it'll be interesting to see also if like how the prices of goods changes. Because I was listening to NBC earlier, and I think the CEO of Carvana said that they're starting to see some supply chain issues begin to ease. They're not only like fully easing, but this is the beginning of some of those like those supply chain issues, at least in like the vehicle industry, beginning to ease. So it'll be interesting to see like over the next couple of months, like how much the supply chain issues begin to resolve themselves, and how much that resolution will be derailed by the current Omicron variant or any new like potential new variant that comes out.
Yeah, I heard some saying that they're expecting like around the June, July time that like none of this stuff is really going to be an issue. Like supply chain is not going to be an issue. Inflation like not going to be as bad as an issue. So I guess that's something to kind of like look forward to. The jobs and stuff, I feel like I don't understand like the psychology of people too much to understand. Like I guess people just don't want to like work as much, I don't know. But either way,
there's a
man.
shift. I was listening to a 60 Minutes interview about the Great Resignation, and part of it was the flexibility that people are looking for in their jobs, being able to work from home. Obviously, a lot of those jobs are like you have to be in the physical store, right? There was this company that was pretty much remotely offering executive assistant jobs to like companies. And so this one lady quit her like stable job to kind of like be like a stay-at-home mom, and then she realized, so I could be working, doing something else, and now she's like an executive assistant for like 2 or 3 companies, and she has her own small business going on, and she gets to do all of it from her couch. So that's part of the explanation to the Great Resignation. Obviously, the baby boomers are like they were due to retire. But it's the landscape is definitely changing in terms of like the flexibility that is expected now. Even and then like the employees now have like a stronger hand, right? They have the stronger hand because now the employers are the ones who are like in dire need of like people, and so they're having to like fold and kind of like give in to those requests. So the market, the way that people work is definitely evolving. And that's a good thing, I think.
Yeah, definitely, man. I love working from home, bro. But yeah, dude, I think that's like a really good segue into like what you guys are planning on doing. I mean, if you guys are planning on doing anything at all, I'll say 2 big things about all of this. Number one, I'm not really too worried, right? Like I'm not too worried about, I mean, again, the biggest thing is like this whole interest rate things that the market is obviously reacting like pretty crazy. It might even be overreacting to it, But number one, I'll say that I'm not worried, and that's because I still think that companies, including tech, are still going to inherently grow, right? Like they're still going to like do well, and I can still expect like pretty good returns. But the second thing that I know as well is that I don't think I'm going to actually look at this year as being like $1 million year. You know what I mean? Like I don't think this is going to be the year that I can quit my job and like just live off of my dividends or something, Like I understand that this year is also going to be like tough, And so with that kind of being said, I'm just looking at this year as like a huge like buying year, right? I was listening to like this hedge fund. I could probably find the name of this guy, but he was on Fast Money on CNBC, and he was just saying like, like historically, or like in his opinion, I guess historically, like he sees like when interest rates like rise, like the Nasdaq can ding like 10 to 20%, each time. And so if they're saying it's going to happen like 4 times this year, like I see nothing but like opportunity in that. You know what I mean? They're just buying opportunities, not opportunities in like, I'm going to get rich, right? Like opportunities in like, I'm going to buy it today and like maybe next year it'll be like something great,
Yeah.
But, again, we'll kind of see that because
definitely
I think
a year to load up on some units to end up on a good side in your 401k.
Yeah, dude.
Couldn't agree more.
Yeah. And so, man, like Josh T over here, bro. FAS is going on my list. Obviously, JPMorgan too, Goldman Sachs. I already have like a couple other things there, but speaking of Goldman Sachs too, Goldman Sachs before the year ended had mentioned about real estate, was talking about that. And obviously everybody knows real estate's like kind of hot right now too. I don't own a house or any real estate for that matter, but I was looking into some ETFs into that. And so I found like a couple. There's like XLRE, and I'll actually share my screen too. And I know that I've been going at this for a while, but oh shoot, is this the right screen?
XLRE, yeah.
Yeah, cool, man. So this is just XLRE over like the past year. Let me click this 1 year just to keep me honest here. But you can see like the green, obviously, candlesticks right here going up, and the red, and like over here the price 48.29, but it's been up 30% in the year. Compare it to the SPY, the S&P, it's around 20%. Do I know how much this is going to continue to grow? I don't know, but that's just definitely one of my measures just to see how it's going to crack up to the market as a whole. But Goldman Sachs was saying in their article that they're expecting real estate to grow 16% next year. And so, I mean, if that's the case, you know, like, why not like try to hop on this? I will say too that I try to go through these constituents to kind of see like, okay, what's making this go up, right? Because like obviously like something's making this go up. And so as I was going through there, it was really hard to find like a quote unquote good company, right? And I say that because like although the stocks were going up, like they were just like real estate investment trust and things like that, but like they had like some pretty like whack like return on assets, meaning like management's not as good, they're not as efficient, you know what I mean? Their current ratios were like below 1, so like clearly like they can't pay their like current liabilities, you know. Their debt to equity were like pretty high, you know, like 60%, you know, and typically I try to be around 40% there, you know, more equity than debt. And so I don't know if there's an actual real estate company that I would actually get into, but I do want to get some exposure into this where it just kind of like lets me you know, have a little bit of the winnings, just a little bit of a reduction of the risk, you know. There's XLRE, and I was also looking at NURE, NURE, which is like a short-term REIT as well, ETF, but this one's doing even like better. This has like been 40% over the past year. I don't know if you guys have looked into real estate or have any opinions about that, but that's my.
I took a while ago with there's like this one stock, I can't remember the name of it. But I think
Simon Property Group.
Oh yeah, I think that was one of the ones I was looking at. And they are pretty well known, but I don't know if I would invest in Simon Property Group, mainly because, you know, like malls are kind of dying. So
yeah,
dude, I mean,
the only story that I hear about real estate, and like I gotta be honest, real estate is not my strength. But I was like, the only story I heard about was like the Zillow scandal, not the scandal, but it's like this Zillow disaster.
Yeah.
Where their algorithm was not taking into consideration like area and amenities and stuff like that. It was purely looking at prices, and so he was like paying 50-60K over asking. And then people were like, yeah, just sell it to Zillow, they'll give you like 100,000 over asking. And then Zillow had to just dump houses, and so obviously they're stuck public. But definitely, you know, again, that's one of the other things being affected by COVID. People are moving out to the burbs, you know, away from the city centers and into the suburbs. And you can have your personal office, you have more space, you have your whatever. Which I'll talk. Yeah, I'll talk about something. I'll talk about work. WeWork as part of that shift. But yeah, that's pretty much all I know about real estate.
Yeah, I mean overall, man, I think those are like the big things that I'm looking into, man. But I mean, I guess lastly, I will say I will obviously be looking into like UPRO and TQQQ always, right? Those are going to be always my go-to, my always defaults, you know. But have you guys thought about UDOW at all, which is like the triple leveraged DAO?
Yeah, they have like more exposure to the industrials, right?
Yeah.
I would say I did consider them. It's just I think overall I've been like I got in the lab. I was looking at all these different leverage ETFs, and it seemed like over like the past 10 years, either like UPRO or I believe TQQQ would outperform or would perform best given like say something like the Sortino ratio or the I don't know why that other metric is
The
escaping me
Sharpe
right
ratio.
now. Huh? Yeah, the Sharpe ratio. I don't know why I can't remember the Sortino ratio, but not the Sharpe ratio. But basically,
Yeah.
Call it
yeah,
the Sharp
the
P
Sharpe
ratio. That's how I always remembered it. Sharp P ratio.
Sharpie.
Like a Sharpie.
Yeah.
I like Sharpies.
Yeah. I think that was like a memory trick then. Yeah, but basically, like with the Sharpe ratio, I think TQQQ is probably one of the best investments that you could have made over like the past 10 years. So I think I'm going to be trying to stock up quite a bit more on TQQQ. I need to do some more research on UDOW. I don't know if it's necessarily the right or ETF, but I'm sure there's like some combination out there given modern portfolio theory that would where UDOW would benefit someone's portfolio, perhaps even mine. Although I do agree as well that I'm expecting to do a lot of buying over the next 6 months, and that's also something we've talked about before. In that there was an article by Bank of America. We talked about that one I think in the beginning of December, where the S&P 500 is supposed to be flat, or at least they're predicting it's going to be flat in 2022. And I think what we're already seeing from this past beginning of a couple of weeks in the beginning of the year is just that even though, sure, maybe 2022 is going to be flat in terms of like by the end of the year, that doesn't necessarily mean the road to being net zero at the end of the year is going to be just a total flat line. There's going to be some volatility involved. And since we're already seeing that in January, I think that's going to be a lot of good opportunities to purchase TQQQ at a steep discount compared to what it was a couple of weeks ago. And so I'm definitely going to be looking to bulk up on some more TQQQ, maybe some more FAS, and even if I can't time the market well and it just goes down shortly afterwards, just holding that over like the next 5 years, I think will just generate tremendous gains because technology has so much potential for us. Case in point with Tesla, which drove TQQQ up quite a bit over 2019 through 2021. Incredible run, and I think there's TQQQ has more bullets in the chamber as well. So I'm going to be looking forward to buying and holding TQQQ for a very, very long time. I can't imagine what would cause me to sell it. I'll just hold it and well beyond the 1 year required for the long-term capital gains tax.
Yeah, I totally agree. Yeah, man. If you want to, man, you want to tell us about WeWork? I know you've been real excited about this one over the past really months, man. And
well, I appreciate the Tesla shout out, obviously. Sad news though, I heard that the Cybertruck is going to be delayed a little bit, at least in Asia. So yeah, but anyway, I think I have a good outlook for Tesla in the future. WeWork is kind of going on in hand with the real estate play, basically because there's also if people aren't going to work downtown where all the commercial real estate is, that's where all that market is, and people are moving away into the suburbs, then commercial real estate is going to be affected. And that's where WeWork comes in, because it's going to pick up the slack. That's going to bridge the gap, really. WeWork is like a shared workspace company that pretty much buys out buildings, and then you open that to you rent offices, cubicles, or whatever to businesses around the building that are locally strategically placed, but also to people who are in our, for example, you and I, Josh, maybe you, Trusty, too, as well. People work from home remotely, want to just get away from working from their house. they go to this particular building that's 10, 20 minutes away or less from their house and set up shop there, and then see other people from other companies and kind of share ideas and stuff like that. And so I'm starting to see the beginning of that momentum of that shift happen already. There's this particular spot 5 minutes away from my house called the Cannon, and actually my brother has a membership. And so again, he shows up, he works, they have like free coffee, they have like amenities, like a big screen, like you can cast the game or whatever as you work. And he likes it, he spends a lot of his time there. So WeWork is going to do the same. Obviously this spot, the Cannon is not listed, but WeWork is currently at $9 a share. And WeWork is going to try to do that globally. So not only in the US market, but also in maybe the Asian market, right? The European market. So I think that has a lot of potential. It's a sleeper, it's like a sleeper stock at the moment because it does have like a bit of a controversial past. But obviously there's definitely, the way Wall Street works can also be very shady. And I think that everything got caught up in that greedy aspect of Wall Street. But anyway, they're finally listed through a SPAC. There's only $9 a share, and I can easily see it at 20. So I'm going to be buying that. It has good opportunity. And again, it's like a sleeper. This is the kind of company that you want to buy before everybody jumps in. And obviously, not a lot of people are in it right now because it's only $9. But I usually have like a $23 target, maybe like a 2-year target at $23. But who knows, right? I mean, it may be 40 or 60 in the short term. But yeah, I would say after Tesla, Tesla, I was a big fan of Tesla before it was like a thing because I thought it had good product, it had a good idea, it had a good idea of changing the drive around and stuff like that. This is kind of like that. WeWork understands where things are moving and they have a vision. Therefore, I think when people realize, hey, this is something special, that's when we're gonna make money on it. But so yeah, highly recommend that WeWork. And we'll see where that goes.
Yeah, I would definitely say that it's challenging the status quo for sure. And I think one of the things that I kind of think about with it, just kind of thinking about it just from like a fundamental point of view, right? Like I don't really know what my future is going to look like in the sense of like I know that I'm going to be trying to work from home as long as I possibly can until if I can until I die or whatever, but probably retire before that. But if I had like kids, like your brother, like you were speaking, right? I imagine that he's doing this Canon thing because like I'm sure there's no doubt in my mind that he loves his wife and his kids, but like it might be kind of hard to like be working with like all this
everybody
stuff
needs a
going
break from the kids. Yeah.
Yeah, and so I mean I thought about moving to Katy, Texas, because I could be away from the city and like I can like have an office and like have some like space and stuff like that. And then I just think like, man, in 15 years, dude, I imagine that I would have like at least like a kid or 2, maybe 3, you know what I mean?
Yeah.
And like I don't know how that would work or how I would continue to work from home if like all this madness is going on, especially if like
exactly.
Yeah, if there needs to be like a babysitter, like
yeah,
but
I mean in Houston for a while, like living in Katy, if you lived in Katy and had a job downtown, it was like that was like the main thing against Katy, like the distance, right?
Yeah.
And but now that kind of problem kind of has gone away, really. If you can work from home, like it doesn't matter where your job is at. Now you can afford like a bigger house, because it's not, hot as a market as, the Heights or whatever, at least here in Houston, Texas. But and obviously have good football programs. I know, Josh, you want your kids to be NFL players, right?
NBA, that'd be cool.
NBA.
Yeah, were you saying, Trusty?
Yeah, I was just gonna say that WeWork is kind of capitalizing on an interesting shift in real estate, but within like it's like the almost like just general like it's I guess like the industry of just like general work, because a lot of companies like no longer really need their really large office spaces if everybody is just working from home. So why not just like liquidate those assets, and then maybe WeWork can just purchase them for people who maybe live in the area and just want to work from home without working from home, so to speak, to just go to like a nearby office and not have to bother their coworkers with the sounds of the kids crying or dogs barking. And pretty much dogs barking has been one of like the anthems of the pandemic era, with people just working from home, and then inevitably the dog starts barking. And yes, I was that guy at several points where the dog was barking in the background, and it's just like much more of a relaxing environment, just to work in like at an office where you don't have to worry about all those background noises or anything of that nature. It's controlled, and it should be ideally convenient for the person who's traveling and just to like a nearby office to work. So, and then also too, like you won't necessarily have like all of your coworkers who might just be stopping by to inundate you with long conversations that may or may not have applied to me.
Yeah, no, that's true. There's that side of people who like to be social and they want to talk about meetings in person, right? But for example, my company at the moment, you know, the meetings I'm a part of, like there's people from like the 3 different time zones. So they were going to happen online anyway. You know what I mean? It's maybe a lot of companies do have an issue with that because like the whole office was like in one floor or building. And then they want to socialize and talk and all that stuff. But LinkedIn had a poll that was asking, you know, you want a hybrid, fully remote, fully office. There was another option, but I think the most popular was like a hybrid, right? Mm-hmm. And the second most popular was like fully remote. So the hybrid, again, you can have your hybrid, and you can be at your home whenever you want, and then go somewhere else to work, like a coffee shop, you know? Like not a lot of people can go to coffee shops because first of all, there's not a lot of space. Second of all, it's not really safe if you have like confidential information going through your meetings. Mm-hmm. And I guess the shared workspace kind of solves those problems at the same time. But yeah, there's definitely a lot of people who just like to be social, and we prefer to see like their colleagues and stuff like that, but hopefully they have a good way to fix that, I guess.
No, yeah. It'll be exciting to see what happens. It's like it definitely has a lot of potential, you know, and it'll be interesting to see because like we were speaking a little bit on Gen Z and everything. And so like my little sister, you know, she's like 10 years younger than me, and like it's so strange because it's like a different beast, a different animal, you know, like we said at one time, like their first toy was like an iPhone, you know? So it's like, and they're very used to being like alone, you know? And so if that's like the future of like our nation, like WeWork could like totally be like a very real and practical thing, you know? I mean, obviously since the pandemic hit, you know, it has proven that people can work very well from home, you know? And I mean, I feel like I'm a little more efficient. Like I never know when to quit. You know what I mean? Like when is it okay to stop? You know, I still see my bosses online, you know. But I mean, you know,
same,
right? Yeah.
At very odd hours, once I see them online, I'm just like, why are you online? And it meant I'm just thinking like, why are you online? But I realized, wait a second. Only reason I know is because I'm also online.
Yeah. Yeah. So I mean, I'm down with WeWork too, you know.
Yeah. It reminds me of just to bring in like a scripture in like Ecclesiastes, not necessarily like a verse, but everything is the same under the sun. So we're talking about nothing like we're not looking at anything new. We're just looking at shifting around, shifting of patterns around. So predict those shifts are going to happen. That's how I approach things, obviously. And that passage has a lot more deeper meaning than just like making money, but
yeah, I
cover that.
was about to say, man, like
We can cover that
on another call, yeah. But yeah, guys. I know it's been like almost an hour, but does anybody have any other thoughts or anything? Anybody want to share like anything else that they want to teach or anything, or something they want to share with the group?
Well, like you were saying, Josh Flores, I think going back to the when we started, right, this meeting, master your money. It says the way you get through an inflation is with discipline, because your rate of return overall over like the whole period is always going to beat out whatever those inflation periods, high inflation periods combined. So yeah, don't change what you're doing. I guess if you're holding on to your 401k, don't make any changes. Just keep contributing to your 401k. Be disciplined. Stay on top of the news and stuff like that, because obviously it's not going to be forever. So
yeah, we always say time in the market is better than timing the market.
Yeah, and you can't buy discipline, but you know what you can buy? Stocks. so like, even though there might be some turbulence in the short term, just like buy now. Even if you happen to buy the top, if you hold it like for a really long time frame, then you can be very certain that you'll have like a profit 20 years like down the line. But I don't think it'll take that long. If you just like, even if you just like bought like the general market, you should turn a profit within the next like several years.
Yeah, I can see that y'all read my Wall Street Journal article, right? Yeah, cool. But awesome, guys. I appreciate it. But next Saturday we can continue the conversation. Hopefully it's a better week, green wise, long wise. That's what I like to do.
Yes.
But thanks, guys.